Well, the S&P 500 is up nearly 12% since the beginning of September, hitting new bull market highs. So it's time to take your winnings and run. Well, some people in the market certainly thinking so today. Joining me now with some perspective is Tobias Levkovich. He's the chief U.S. equity strategist for Citigroup. His year-end target for the S&P is 1175. So, Tobias, when you were last on the show back in September, you were telling me then that equities are about 25 to 30% undervalued. What are you thinking now?
They still are, but we're looking at kind of 12, 13, 14 months from now, and I do think at the end of 11, we're looking at 1,300 on the S&P, so that would be another 10% higher, and we're up, give or take off the August lows, about 16% on the S&P. So we're closing in on that 25, 30% undervalued status. So, we are moving in the right direction. The problem right now, I think, is the markets have run on QE2, on the midterm elections, on really some good earnings numbers in the third quarter. And so many investors are kind of hoping for the quote-unquote late-year rally, and I think it got pulled forward into September and October. So we probably are going to kind of wobble around here for a little bit and maybe ease off a tad by the end of the year.
Not much momentum right now. You see a report out from Cisco like we got just yesterday afternoon, and it shocked a lot of people that demand was that misread. But you've been avoiding tech or lessening exposure to tech for a while. Yeah,
we've been worried about tech for a number of reasons. One of them has to do with earnings estimate revision trends, and we watch that momentum very carefully. So, for example, in chip stocks, over 90% of the estimate revisions were to the upside back, call it 4 or 5 months ago, and that's an unsustainably high level. It's pretty extreme, and we've seen that roll over with the chip stocks. If you look at tech hardware, which would be where Cisco would fit in, as would some other large companies, selling equipment into the industry, there we have lead indicators that we track, over 330 economic statistics that tell us where likely trend direction is for stock prices with 12-month lags, and they've already been signaling that area would be under some pressure. Now, that doesn't mean fundamentals of the business are poor. I mean, in the company you're talking about, I think there was a lot of discussion around government spending.
Right.
And that's not corporate spending.
No, it gets to the debt and deficits conversation.
that takes you down a different path, you're right. But the notion of corporate spending is actually probably going to be pretty good, given that it's lagged corporate profit margins have improved, it lags corporate profit trends. There is some companies that do need to make some refresh on their technology investments. So that's probably going to be okay, but stocks don't always follow business fundamentals. They have other factors that they follow, and we might just see multiple compression here.
Well, in your note from November 5th, I was reading through, and you talk about sort of some cross currents, that the correlations that you traditionally see play out aren't there. A weak dollar doesn't necessarily mean higher commodities in this kind of market.
Well, but what weak dollar actually means to a certain degree is a risk tolerance. So they start buying stocks, they start buying commodities, they start buying risk assets, and they move away from risk factors. I'm actually kind of annoyed almost by the headlines I see. The market is up because the dollar's down. No, they're coincident phenomenon. They're two sides of the same trade. If I want to take risk on buying stocks, and I don't buy the dollar for safety, and if I want to buy safety, I go back to the dollar and I move away from stocks. And to that degree, I even move away from gold, because gold is highly correlated with stocks now.
Well, gold, a lot of people seeing different versions of whatever trade they want to take there when they look at it. But talk to me about what the next catalyst there. If we're misreading some patterns here, what should we be looking at?
Well, I think the big thing that we're going to be talking about over the next few weeks is, as the lame duck session goes back into session and the president comes back from Asia, there's going to be a lot of discussion around the Bush tax cut expiration and what can we afford to do, what can't we do. And I think most people believe the permanent extensions are a difficult thing to do given where our budget deficits are today and our debt burdens. Extending them for 2 years is what we were hearing back 7-8 weeks ago in Washington that people were talking about. And then it gets to, where do you do it? $250,000, $500,000, $1 million. And this whole debate around the permanent extension is kind of silly, almost in the sense that talking about the top 2% extensions, permanent in Washington terms means 10 years, costs $700 billion. Doing it for everybody else costs $3 trillion. So it's almost a sideshow to talk about $700 billion when we don't talk about $3 trillion.
Right.
If we can't afford $700 billion, we certainly can't afford $3 trillion. And 2-year extension is a different story than the 10-year extensions. And this is an important, political debate. And
it is.
We're going to be watching it. I don't think markets are necessarily focused on that right now. I think there's an assumption.
We got to leave it. We got to leave it right there.